The best way for increasing your money is unquestionably investing. The majority of people never receive high six-figure salaries or significant windfalls of money. Therefore, they must use the stock market's potential to increase their fortune. It may get in the way of buying and holding inexpensive stocks or investing in retirement funds. In any case, investing has a role to play in your equation for financial development. Sadly, many investors, from those just starting out to those with a lot more expertise, make crucial mistakes that limit their ability to profit from investments. In this video, I'll share with you 7 investing blunders you absolutely must avoid. If you're new to the channel, be sure to smash the like and subscribe buttons below for more life-changing knowledge. The first mistake is purchasing shares in a company that you are unfamiliar with. Investors frequently favor the newest, sexiest, or more expensive-sounding sectors. They might have little to no knowledge of biotechnology, technology, or the particular industry the underlying company operates in. Of course, that does not prevent individuals from investing in a stock they believe will lead to financial independence. They actually give up the advantages they would have had over other investors if they had simply been prepared to devote the time required to become more educated by making these purchases without understanding the company to which the stock is tied. You see, you automatically have an advantage over most other investors when you comprehend a firm. If you own a restaurant, for instance, you'll be more familiar with companies engaged in restaurant franchising. Additionally, you'll see the customers' routines up close and in advance of their becoming well-known. Consequently, you will be well ahead of most investors in knowing whether the business is flourishing, slowing down, or cooling off. To continue with our example, you should be able to identify some opportunities to make a wise investment choice by keeping an eye on the trends in the sector in which you are active. Gaining first-hand knowledge is frequently linked to successful investing. You risk not comprehending the nuances and complexity of the business in question if you invest in a firm that is beyond your area of expertise. This does not imply that you must be a pilot to invest in the airline industry or a doctor to invest in the medical field, although that hardly would do any harm. Anytime you have an unfair advantage over the majority of investors, you should maximize that advantage. Knowing when to invest in companies that generate their money through litigation may be beneficial if you are a lawyer. Being a surgeon will help you appreciate how well or poorly a surgery robot is doing its job, and as a result, you may have an advantage in predicting how well the underlying stock will perform. Too high of expectations is the second error. The typical investor frequently expects to see a high rate of money on their investment when they decide to invest in stocks, and this is particularly true when dealing with penny stocks. The majority of individuals think that they can make a modest fortune with $500 or $2,000 by buying low-priced stocks, treating them like lottery tickets. In fact, this is occasionally true, but it's not the right attitude to have when you first start investing. Even if these figures are considerably less exciting and fantastical than what you could wish for, you must be realistic about what you can anticipate from the performance of the shares. Look at the stock's performance up to this point and keep an eye on all other investments that are competitors in the same industry when choosing a stock you wish to invest in. Has the underlying investment historically increased by 5% or 10% annually? Or did those changes amount to many hundred percentage points? Are shares of most companies in the sector typically moving 1% at a time, or do they frequently increase by tenths of percentage points? While past performance is not necessarily a predictor of future results, it can give you a sense of the volatility and trading activity of the underlying shares. A stock will normally continue to behave much as it has in the past, and this behavior will typically be consistent with the industry as a whole. When investing your money in stocks generally, you need also keep in mind what the alternative is. You will receive almost nothing in return if you leave your money in a checking or savings account, which makes your investing efforts look much more successful even if they aren't producing you as much money as you would have expected when compared to a 5% stock return. Investing money you can't afford to lose is the third error. The majority of people start saving their money and purchasing stocks as soon as they realize how effective investing can be for increasing your wealth. Sadly, most of the time they are investing money that they would otherwise use to pay bills or add to an emergency fund. and it's not a good idea to use this tactic. The money in your trading approach while utilizing funds that you cannot afford to lose will astound you. You make buy and sell decisions that you never would have made otherwise as a result of your emotions being more volatile and your stress levels skyrocketing. You will eventually lose every dollar you gamble with, according to an old Japanese saying. Never put yourself in a situation under pressure when you are risking money that you need for other reasons. Investing solely paper money is one way to practice investing before putting any money at risk. This doesn't include investing your $100 rather than your cents. It entails choosing the stocks you wish to buy and noting them down, rather than immediately buying them. Before utilizing actual money, you can track your investment choices and gain a better grasp of your financial skills. Delaying would also allow you more time to accumulate money for investments. You will make much more relaxed trading selections when you trade with money that you can afford to risk. Generally speaking, when you trade without being influenced by fear or other bad feelings, you will be considerably more successful. Inability to wait is mistake number 4. We may have mentioned a few of the numerous emotions that you can have while investing, but impatience is one of the most expensive ones. Keep in mind that stocks are ownership shares in a specific company. Businesses often run much more slowly than most of us would prefer or even anticipate. When management devises a new strategy, it can take months or even years before that new approach begins to bear fruit. All too frequently, investors will purchase stock and then expect the shares to act in their best interests right away. This blatantly disregards the much more practical timeline that businesses operate on. In general, stocks will take far longer to move in the direction you expect or hope they will. When people first invest in the company's shares, they shouldn't allow impatience to rule their actions or their finances. Relying on incorrect advice is mistake number 5. This is a really significant point. There is no scarcity of so-called experts who are prepared to share their thoughts with you while presenting them in a way that makes them appear informed and constantly accurate. Finding and separating sources of advice that regularly assist you in making money is one of the most important aspects of investing properly. You will probably come across hundreds of pieces of terrible advice for every helpful piece of information. Always keep in mind that just because someone is being featured in or interviewed by reputable media outlets, it does not necessarily mean they are an expert in the field. And in fact, even if they do have a solid understanding of their subject, that does not guarantee they will be correct. As a result, it is your responsibility as an investor to determine which information sources can be relied upon and have a consistent track record of sound advice. Even once you've found the people or services that could generate revenues, you shouldn't fully rely on their options. To build your trading decisions, mix those with your own research and judgment. Additionally, if you learn about a stock for free, particularly a penny stock, you may be almost assured that its drivers have strong ulterior motives. This might not be true if you hear a professional's view on something like CNBC, but it is unquestionably true when you hear about the most recent hot penny stock that greedy stock promoters predict would skyrocket. There are countless dishonest stock promoters in the world. Finding methods to profit from your behavior is their preoccupation. They win because you lose. You must realize that investing speculative shares is a zero-sum game, implying that for someone to make $1, $1 must be lost by someone else. This explains why promoters and con artists make such an effort to raise worthless shares. They will profit more when they walk away and abandon everyone else in the dust, broke, the more money they receive to drive stock prices up. Investing with the crowd is mistake number 6. Frequently, the bulk of people only learn about an investment after it has proven successful. The mainstream media frequently covers price increases of various stock kinds and stocks on how popular the shares have become. Sadly, by the time the media takes an interest in a story about a new stock increasing in value, its price has already peaked. Attempting to join the bandwagon at this time would only result in you losing money when the stock price starts to slide back down to earth because the investment is already inflated. Recent developments in the recreational marijuana stocks have demonstrated this trend. Even though some of these small businesses only had 2 or 3 employees, their corporate worth was still estimated to be above $500 million. In other cases, an ancient, nearly defunct gold mine would add the word marijuana or cannabis to the name of their business, and the price of the shares rose by a factor of 2 or 3. Investors never dug deep enough into the business to fully understand all the issues. Debt of tens of millions of dollars, no income, and continual monthly losses of millions. Don't invest like the majority of people because their sources of information can be outdated by the time you need to make a smart investing choice. Using the sunk cost fallacy as an excuse is mistake number 7. In more technical words of investing, this is known as averaging down. The sunk cost fallacy is simply stated as when people continue a behavior because they have already put money in it. Averaging down results from someone making an investment mistake and attempting to fix it by investing more money to the equation. For instance, if they acquired a stock at $3.50 and it lowers to $1.75, they can buy a lot more shares at the new lower price to lessen the impact of their mistake. As a result, their average price per share is substantially lower as they have now purchased stock at $3.50 and more at $1.75. This makes their stock loss seem much smaller. However, the truth is that people acquired a stock that lost value, and they are now investing even more money in this losing deal. Due to this, some analysts contend that averaging down amounts to nothing more than throwing good money after bad. If you decide to average down, keep in mind Warren Buffett's wise words. Stopping your digging is the most crucial action to do if you find yourself in a hole. If you wish to be successful in your investing journey, make sure to avoid making these huge investing mistakes. If you truly have the desire for financial success, your journey will take you more than a dream and perseverance, making sure every step you take will lift you up towards your dream of being the next successful investor. That's it for today's video. If you like it, make sure to smash the like and subscribe buttons and turn on all notifications. Thank you very much for taking the time to watch. Until next time!